Financial Modeling, Topic 17, Delta Hedging. Section 3, Constructing Delta Hedges and Computing Delta Hedge Profits for 1 day. So let's look at this 6:15 March call on Google. At the time, I had an implied volatility of 18.67. In prior topics, we've estimated volatility, and our best two models we think are EWMA and GARCH, in particular GARCH. And those models are telling us that that vol, our best estimate, might be 23%. So that might lead you to the conclusion that maybe we should buy this option for 10.05 because we think it should be worth much more. If I were to plug in 23% into this valuation, these numbers are much higher. So I'm going to buy this undervalued call. However, the problem with doing this strategy is if I buy the call, I am what we call long volatility, which is the position I want to be in, meaning I just want other traders to get as smart as me, apply the GARCH model, plug in a higher number, and this thing will appreciate. However, if I buy the call, I'm not only long volatility, I'm also long the stock. Remember, the delta of this option was about 50 cents. So if I buy the option, hoping implied vols increase, I'm exposed to a decrease in the stock price. How much am I exposed to? Well, if I take my delta times the change in stock price, that tells me how much the option price will change based on positions in or changes in the underlying. So that's the problem with my speculating on volatility. However, what I'm going to do to deal with that second problem of having exposure to the stock is what I'm going to do is I'm going to hedge out the stock price risk by taking a position in delta shares. Remember, delta is my exposure to the of the option price with respect to stock. So if I can hedge out the stock price risk in the option by taking a position in delta shares, I can just be left with simply my vol bet. And that's what I want to do. Now, for delta hedge positions, remember you could buy calls or sell calls, buy puts or sell puts. You have 4 positions. Now you're going to buy calls and puts if you believe that the vols are too low, the implied vols are too low. So you believe those options are undervalued, so you're going to buy them. You could sell calls and puts because you believe the volatility is too high. You think that implied vol is going to go down, so you short those options. Now, since the position in delta shares replicate the option's stock price risk, the delta hedger must take the opposing position in the option delta. Now that was a mouthful, but let's think about this. If I buy the call, I know that I can replicate the call's exposure or my exposure to the call with respect to the underlying stock price is 49 cents. So what I could do is I could sell half a share of stock for every option I go long. And since if the stock price goes up by stock price goes down by $1, the option would lose 50 cents, but if I shorted half a share, I'd gain 50 cents. So that's the basic intuition into delta hedging, is you would buy or sell the option and then take the opposing position in the delta. Now let's go through the 4 positions. If I were to buy the call, the delta for this call is about 50 cents. I would short this delta. What that means is I change the sign of it, and what I would wind up doing is short selling 49.78 shares. Now, if I were to sell the call, I would have to replicate that by buying the delta or buying 0.4978 shares. If I buy the put has negative exposure to the stock price. So if I want to buy the put, I'd short this delta, which means I change that from a negative to a positive. So if I buy the put, I wind up buying about a half share. And if I sell the put, I'll buy the delta, meaning don't change the sign. In other words, I would short 0.50 shares. So those are my 4 delta hedge positions. That's the recipe for putting a delta hedge in place and simply take a bet on volatility. These 2 bets, you're going to be long vol. These 2 bets, you're going to be short vol. You're hoping it falls and you think the options are overvalued. Notice that all call deltas are positive, all put deltas are negative. Therefore, these 4 positions are true for all delta hedging. So back to our delta hedging example. What I want to do is I want to do a delta hedge for 1 day, and I'm going to have the stock price change by $7.22. No change in vol, no change in interest rates. It's 1 day older. Now, where did I get $7.22? Well, I know I'm going to take the implied volatility of 18.67%. I'm going to divide by the square root of 252 to turn that into a daily standard deviation. And then I'm going to multiply that daily standard deviation times the stock price to see what is a 1 standard deviation change in the underlying stock. And that turns out to be 722. That's important later. But for now, we can just say I'm just going to pretend there's a $7.22 drop in the stock price. And I want to see what my P&L is. Again, I'm betting on volatility, but volatility is not changing. But I'm going to see what my P&L is if I put on the delta hedge. So we're going to go to our spreadsheet. I'm going to change this to no change in interest rates, no change in implied vols. It's 1 day older, and I want to have the stock price fall by $7.22. All right, and that would be, if I bought the option, that would be a terrible thing to happen because remember the delta is positive. So that's the hedge. That's my position. I'm going to buy the call on this date. I'm going to short delta shares. Oh, by the way, this option is on 100 shares of stock. So I have an option on 100 shares. When I short the delta there, what I'm going to do is I'm going to sell 0.4978 shares for every 100 shares of option. So I'm going to wind up at selling 49.78 shares of stock. So let's go ahead and do this. I have this rounded to 50 shares. Let's go ahead and do it on the exact number of shares. Let's pretend we can do fractional shares. So I'm going to take minus my duration. My duration is, or my delta is 0.4978 times 100 shares. I'm going to short 49.77 shares of stock. Now you could round this to 100. We'll do that, or 50, and I'll do that later at some point. All right, so let's figure out our first cash flow. I'm going to first buy this option at 10.05 on 100 shares. That's going to cost me $1,000. Then I'm going to short 49 shares. So that's 49 shares. I'm going to change that to positive 49 shares times 614. When I short sell, I'm going to generate cash of $30,576. So I'm going to borrow shares, 49.78 shares, sell them. I'm going to generate cash of $30,000. I bought the call in 100. That cost me $1,000.05. So that I'm actually going to generate cash of $29,571 to put on the delta hedge. I'll then invest that $29,571 overnight. And so I have no outlay of cash or intake of cash in my initial trade because I'm going to invest this overnight at the risk-free rate. Now, I have this hedge on. As of this date, I am short 49.78 shares of this stock, and I own 100 shares, or an option on 100 shares. The next day, it's 1 day later, and the stock price falls by 722. It's 1 day later, and the option price is going to fall from 10.05 to 647. Remember, for 2 reasons, it's going to do that. Here's a little return attribution right here. It's going to fall because this option has a positive delta, and if the stock price falls by 722, take 722 times the delta. I should lose $3.60 times 100 shares. I should lose $360. However, it's not so bad because of the positive gamma. So the net effect of the stock is looks like I'm going to lose a little over $300. However, it's 1 day older. I lose 40 cents per option share times 100. I lose $40 because the option's 1 day older or time decay. So if I did no hedging, I'm going to lose about $359 or $358 if I did not delta hedge this option, waiting for this implied vol to go up. However, I do have a delta hedge. I'm short 49.78 shares. So let's get my total P&L. I'm going to take my option I own. That option lost $3.58 times 100 shares. That option lost $358. However, if I take my short position in my shares times the change in the stock price, remember, if you're short and the stock price goes down, you win. So I'm going to gain $359 because of the stock price increase. I then have this interest that I've earned on $29,571. I'm going to take that, divide it by the risk-free interest rate, 10 basis points. Divide that by 252 to get 1 day's interest. Whoops, I need to multiply that investment balance times the interest rate and divide by 252. And what I get is I get 12 cents of interest for 1 day. So notice what is happening in this P&L. I want to buy this call because I'm hoping this implied vol goes up. However, while I'm holding it, the stock price falls and I would have taken a huge loss, about $358, $359. However, since I'm delta hedged, I'm almost perfectly offset. Notice the P&L from the call is almost perfectly offset by the P&L on the stock. Add a little bit of interest and I basically broke even. So this is the perfect delta hedge, nearly perfect delta hedge. I have protected myself from the fall in the stock price. So that is the example of 1 day of establishing a delta hedge, and then 1 day later how to calculate your profit on that delta hedge. In the next topic, we'll talk about the relationship between that change in stock price, say that $7.22, and your delta hedge profits.